Is the Federal Reserve about to make the biggest mistake in its history? Let's find out. In this video, we're going to highlight some of the risks facing investors and how they may impact our portfolio. If you have been watching the news or bought something for your business or household lately, you may have noticed prices have soared significantly in the last year. And you might wonder, why is that? The answer is deeply embedded in the Federal Reserve's extremely accommodative monetary policy, which started in early 2020 to stimulate the economy. In order to avoid a recession or a Great Depression during the pandemic, the Fed reduced the key interest rate to an all-time low level while printing trillions of dollars to buy government bonds and mortgage-backed securities to stimulate the economy. By doing so, the Fed essentially increased the net worth of many American investors who own homes and stocks by propping up their asset prices by lowering the borrowing cost, which made them feel richer, and in return they spent more money. Economists call this phenomenon the wealth effect. The wealth effect is a behavioral economic theory suggesting that people spend more money as the value of their assets rise. Of course, the opposite is true. When asset prices decline, so will the expenditure of the asset owners, and that has the potential of causing a slowdown in the economy. Now, with the wealth effect and the provision of stimulus checks, while the economy was essentially on hold from producing goods, the demand exceeded supply. When that happens, guess what? Prices go up. Now, the wealth effect is something that has benefited a small proportion of Americans. Many people who don't own homes or stocks have seen their cost of living rise and net worth decline. In the latest CPI print, or Consumer Price Index, a way for economists to measure inflation in the economy, we've seen an average price rise of 7.5% in January 2022, with items like energy and food taking the lead. This is the worst inflation in 40 years. As inflation is at multi-decade high, the Federal Reserve is still continuing its accommodative monetary policy by purchasing $30 to $40 billion a month in bonds to prop up bond prices and keep interest rates low, a move that has been criticized by many experts and economists, including Lawrence Summers, a former United States Secretary of Treasury. Summers argues that the Fed should end quantitative easing and start tightening financial conditions, as the Fed is behind the curve. Behind the curve means that the central bank is not raising interest rates at a pace fast enough to keep up with inflation. This phenomenon could potentially trigger a runaway inflation, similar to what happened in the 70s, when inflation reached double digits. At its worst, inflation was above 14% in 1980. In order to tackle inflation, Paul Volcker, the Fed chairman at that time, raised interest rate to above 20%. That led to the economy entering a series of recessions. It took a much higher interest rate than inflation in order to break inflation. Currently, inflation is at 7.5%, and the Fed's fund rate is effectively at zero. That means the interest rate has to go a lot higher in order to curb inflation. Investors need to keep in mind that higher interest rates mean lower asset prices. This is because hedge fund managers and professional investors use the discounted cash flow formula to determine how much they should pay for an investment. To apply the formula in its most simplistic form, for the sake of not complicating this to the novice viewer, a professional investor would take the expected cash flow of 5 to 10 years of a business and divide it by the risk-free rate of return that they would get from investing in a 10-year government bond to determine how much they should pay for the company. For example, let's say there is a company named Pineapple that is a leader in the tech sector, and everyone loves this company. For simplicity, Pineapple has $0 in debt, and it is expected to generate $1 million in cash flow in the first year, $4 million in the second year, and $8 million in the third year. Let's also assume that Pineapple has 1 million in outstanding shares, and we would like to determine its value by using the 10-year government bond yield as our safe investment rate of return, which in this example is 2%. In order to determine how much to pay for Pineapple, the tech giant, we need to discount the expected cash flow by the discount rate of 2%. When we do that, we arrive to a net present value of $12,363,645. Now let's take that and divide it by 1 million shares. We will get a price per share of $12.36. Now let's assume due to inflation the yield on the 10-year government bond goes up to 7%, which in this example, it is our discounted rate. That means by applying the same formula, but with the new discounted rate, we arrive to a net present value of $10,958,717. When we divide that by 1 million outstanding shares, we get $10.95 per share. As you can see in this example, a rise in interest rate or the discount rate due to inflation leads to lower share prices based on the discounted cash flow formula, which is used by professional investors and maybe some retail investors to determine how much to pay to acquire a business or a company. Although hedge fund managers and professional investors use a far more complex discount rate which factors in opportunity cost and weighted average cost of capital and blah blah blah, which I chose to eliminate from this example for simplicity so that I don't lose you. It is safe to say that when borrowing costs go up, the present value of an asset tends to decline. With that being said, keep an eye on inflation, interest rate, and perhaps stay away from high growth stocks and negative cash flow yielding assets, as they tend to do really bad in an environment of rising interest rates. If you like this video, please subscribe to our channel and hit the bell button, as we will be creating more content like this in the future. I hate for you to miss out on hours and hours of research. See you in the next one.